Hey guys, welcome back to another video. चैप्टर 11 पार्ट 2 इस वीडियो में कवर करेंगे. हम ट्रेडिंग इन द जोन का चैप्टर 1 टू 10 ऑलरेडी कवर कर चुके हैं और चैप्टर 11 कर रहे हैं. वर्ड बाय वर्ड आप सुन सकते हो वाइल वॉकिंग, वाइल ड्राइविंग या फिर सोने से पहले, जैसा भी आपको ठीक लगे. तो बिना किसी देरी के स्टार्ट करते हैं. Exercise. Learning to trade and edge like a casino. The object of this exercise is to convince yourself that trading is just a simple game of probabilities, not much different from pulling the handle of a slot machine. At the micro level, the outcomes to individual edges are independent occurrences and random in relationship to one another. At the macro level, the outcomes over a series of trades will produce consistent results. From a probabilities perspective, this means that instead of being the person playing the slot machine as a trader, you can be the casino if: number 1, you have an edge that genuinely puts the odds of success in your favor. Number 2, you can think about trading in the appropriate manner. And number 3, you can do everything you need to do over a series of trades. Then, like the casinos, you will own the game and be a consistent winner. Setting up the exercise. Pick a market. Choose one actively traded stock or futures contract to trade. It doesn't matter what it is, as long as it's liquid and you can afford the margin requirements for trading at least 300 shares or 3 future contracts per trade. Choose a set of market variables that define an edge. This can be any trading system you want. The trading system or methodology you choose can be mathematical, mechanical, or visual. It doesn't matter whether you personally design the system or purchase it from someone else. Nor do you need to take a long time or be too picky trying to find or develop the best or right system. This exercise is not about system development and it is not a test of your analytical abilities. In fact, the variables you choose can even be considered mediocre by most traders' standards, because what you are going to learn from doing this exercise is not dependent upon whether you actually make money. If you consider this exercise an educational expense, it will cut down on the amount of time and effort you might otherwise expend trying to find the most profitable edges. For those of you who might be wondering, I am not going to make any specific recommendations about what system or variables you should use, because I assume that most of the people reading this book are already well schooled in the technical analysis. If you need additional assistance, there are hundreds of books available on the topic, as well as system vendors who are more than willing to sell you their ideas. However, if you have made a genuine attempt to do this on your own but are still having problems picking a system, you can contact me at markdouglas.com or tradinginthezone.com and I will make some recommendations. Whatever system you choose to use has to fit within the following specifications. Trade entry. The variables you use to define your edge have to be absolutely precise. The system has to be designed so that it does not require you to make any subjective decisions or judgments about whether your edge is present. If the market is aligned in a way that conforms with the rigid variables of your system, then you have a trade. If not, then you don't have a trade, period. No other extraneous or random factors can enter into the equation. Stop loss exit. The same conditions apply to getting out of trade that's not working. Your methodology has to tell you exactly how much you need to risk to find out if the trade is going to work. There is always an optimum point at which the possibility of trade not working is so diminished, especially in relationship to the profit potential, that you are better off taking your loss and getting your mind clear to act on the next edge. Let the market structure determine whether this optimum point is, rather than using an arbitrary dollar amount that you are willing to risk on a trade. In any case, Whatever system you choose, it has to be absolutely exact, requiring no subjective decision making. Again, no extraneous or random variables can enter into the equation. Time frame. Your trading methodology can be in any time frame that suits you, but all your entry and exit signal have to be in the same time frame. For example, if you use variables that identify a particular support and resistance pattern on a 30-minute bar chart, then your risk and profit objective calculations also have to be determined in a 30-minute time frame. However, trading in one time frame does not preclude you from using other time frames as filters. For example, you could have as a filter a rule that states you are only going to take trades that are in directions of the major trend. There is an old trading axiom that the trend is your friend. It means that you have a higher probability of success when you trade in the direction of the major trend if there is one. In fact, the lowest risk trade with the highest probability of success occurs when you are buying dips in an uptrending market or selling rallies in a downtrending market. To illustrate how this rule works, let's say that you have chosen a precise way of identifying support and resistance patterns in a 30-minute time frame as your edge. The rule is that you are only going to take trades in the direction of the major trend. A trending market is defined as a series of higher highs and higher lows for an uptrending market and a series of lower highs and lower lows for a downtrending market. The longer the time frame, the more significant the trend. So a trending market on a daily bar chart is more significant than a trending market on a 30-minute bar chart. Therefore, the trend on the daily bar chart would take precedence over the trend on the 30-minute bar chart and would be considered the major trend. To determine the direction of the major trend, look at what is happening on a daily bar chart. If the trend is up on the daily, you are only going to look for a sell-off or retracement down to what your edge defines as support on the 30-minute chart. That's where you will become a buyer. On the other hand, if the trend is down on the daily, you're only going to look for a rally up to what your edge defines as a resistance level to be a seller on the 30-minute chart. Your objective is to determine in a downtrending market how far it can rally on an intraday basis and still not violate the symmetry of the longer trend. In an uptrending market, your objective is to determine how far it can sell off on an intraday basis without violating the symmetry of the longer trend. There is usually very little risk associated with these intraday support and resistance points because you don't have to let the market go very far beyond them to tell you the trade isn't working. Taking profits. Believe it or not, of all the skills one needs to learn to be consistently successful trader, learning to take profits is probably the most difficult to master. A multitude of personal, often very complicated, psychological factors as well as the effectiveness of one's market analysis enter into the equation. Unfortunately, sorting out this complex matrix of issues goes way beyond the scope of this book. I point this out so that those of you who might be inclined to beat yourself up for leaving money on the table can relax and give yourselves a break. Even after you have acquired all the other skills, it might take a very long time before you get this one down pat. Don't despair. There is a way to set up a profit-taking regime that at least fulfills the objective of the fifth principle of consistency. If you're going to establish a belief in yourself that you are a consistent winner, then you'll have to create experiences that correspond with that belief. Because the object of the belief is winning consistently. How you take profits in a winning trade is of paramount importance. This is the only part of the exercise in which you will have some degree of discretion about what you do. The underlying premise is that in a winning trade you never know how far the market is going to go in your direction. Markets rarely go straight up or straight down. Typically, markets go up and then retrace some portions of the upward move, or go down and then retrace some portion of the downward move. These proportional can make it very difficult to stay in a winning trade. You would have to be an extremely sophisticated and objective analyst to make the distinction between a normal retracement when the market still has the potential to move in the original direction of your trade, and a retracement that isn't normal when the potential for any further movement in the original direction of your trade is greatly diminished, if not non-existent. If you never know how far the market is going to go in your direction, then when and how do you take profits? The question of when is a function of your ability to read the market and pick the most likely spots for it to stop. In the absence of an ability to do this objectively, the best course of action from a psychological perspective is to divide your positions into thirds and scale out the position as the market moves into your favor. If you're trading future contracts, this means your minimum position for a trade is at least 3 or 4 contracts. For stocks, the minimum position is any number of shares that is visible by 3 or 4, so you don't end up with an odd lot order. Here is the way I scale out of a winning position. When I first started trading, especially during the first 3 years, I would thoroughly and regularly analyze the results of my trading activities. One of the things I discovered was that I rarely got stopped out of a trade for a loss without the market first going at least a little way in my direction. On average, only one out of every 10 trades was an immediate loser that never went in my direction. Out of the other 25 to 30% of the trades that were ultimately losers, the market usually went in my direction by 3 to 4 ticks before revising and stopping me out. I calculated that if I got into the habit of taking at least a third of my original position off every time the market gave me those 3 or 4 ticks at the end of the year, the accumulated winnings would go a long way towards paying my expenses. I was right. To this day, I always, without reservation or hesitation, take off a portion of a winning position when the market gives me a little to take. How much that might be depends on the market. It will be different amount in each case. For example, in treasury bond futures, I take a third of my position off when I get 4 ticks. In the S&P futures, I take a third of a profit of 1.5 to 2 full points. In a bond trade, I usually don't risk more than 6 ticks to find out if the trade is going to work. Using a 3 contract trade as an example, here is how it works. If I get into a position and the market immediately goes against my without giving me at least 4 ticks first, I get stopped out of the trade for an 18 tick loss. But as I have indicated, this doesn't happen often. More likely the trade goes in my favor by some small amount before becoming a loser. If it goes in my favor by at least 4 ticks, I take those 4 ticks on one contract. What I have done is reduce my total risk on the other 2 contracts by 10 ticks. If the market then stops me out of the last 2 contracts, the net loss on the trade is only 8 ticks. If I don't get stopped out on the last 2 contracts and the market moves in my direction, I take the third of the position off at some predefined profit objective. This is based on some longer time frame support or resistance, or on the test of a previous significant high or low. When I take profits on the second third, I also move the stop loss to my original entry point. Now I have a net profit on the trade regardless of what happens to the last third of the position. In other words, I now have a risk-free opportunity. I can emphasize enough, nor can the publisher make the words on this page big enough to stress how important it is for you to experience the state of risk-free opportunity. When you set up a situation in which there is risk-free opportunity, there is no way to lose unless something extremely unusual happens like a limit up or limit down move through your stop. If under normal circumstances there is no way to lose, you get to experience what it really feels like to be in a trade with a relaxed, carefree state of mind. To illustrate this point, imagine that you are in a winning trade. The market made a fairly significant move in your direction, but you didn't take any profits because you thought it was going even further. However, instead of going further, the market trades all the way back to or very close to your original entry point. You panic and as a result liquidate the trade because you don't want to let what was once a winning trade turn into a loser. But as soon as you are out, the market bounces right back into what would have been a winning trade. If you had locked in some profits by scaling out, putting yourself in a risk-free opportunity situation, it's very unlikely that you would have panicked or felt any stress or anxiety for that matter. I still have a third of my position left. What now? I look for the most likely place for the market to stop. This is usually a significant high or low in a longer time frame. I place my order to liquidate just below that spot in a long position or just above the spot in a short position. I place my orders just above or just below because I don't care about squeezing the last tick out of the trade. I have found over the years that trying to do that just isn't worth it. One other factor you need to take into consideration is your risk to reward ratio. The risk to reward ratio is the dollar value of how much risk you have to take relative to the profit potential. Ideally, your risk to reward ratio should be at least 3:1, which means you are only risking $1 for every $3 of profit potential. If your edge and the way you scale out of your trades gives you a 3:1 risk to reward ratio, your winning trade percentage can be less than 50% and you will still make money consistently. A 3:1 risk to reward ratio is ideal. However, for the purpose of this exercise, it doesn't matter what it is, nor does it matter how effectively you scale out as long as you do it. Do the best you can to pay yourself at reasonable profit levels when the market makes the money available. Every portion of a trade that you take off as a winner will contribute to your belief that you are a consistent winner. All the numbers will eventually come into a better alignment as your belief in your ability to be consistent becomes stronger. Trading in sample sizes. The typical trader practically lives or dies on the results of the most recent trade. If it was a winner, he will gladly go to the next trade. If it wasn't, he will start questioning the viability of his edge. To find out what variables work, how well they work, and what doesn't work, we need a systematic approach, one that doesn't take any random variables into consideration. This means that we have to expand our definition of success or failure from the limited trade-by-trade perspective of the typical trader to a sample size of 20 trades or more. Any edge you decide on will be based on some limited number of market variables or relationships between those variables that measure the market's potential to move either up or down. From the market's perspective, each trader who has the potential to put on or take off a trade can act as a force on price movement and is therefore market variable. No edge or technical system can take into consideration every trader and his reasons for putting on or taking off a trade. As a result, any set of market variables that defines an edge is like a snapshot of something very fluid, capturing only a limited portion of all the possibilities. When you apply any set of variables to the market, they may work very well over an extended period of time, but after a while you may find that their effectiveness diminishes. That's because the underlying dynamics of the interaction between all the participants is changing. New traders come into market with their own unique ideas of what is high and what is low, and other traders leave. Little by little, these changes affect the underlying dynamics of how the market moves. No snapshot can take these subtle changes into consideration. You can compensate for these subtle changes in the underlying dynamics of market movements and still maintain a consistent approach by trading in sample sizes. Your sample size has to be large enough to give you variables a fair and adequate test, but at the same time small enough so that if their effectiveness diminishes, you can detect it before you lose an inordinate amount of money. I have found that a sample size of at least 20 trades fulfills both of these requirements. Testing. Once you decide on a set of variables that conform to these specifications, you need to test them to see how well they work. If you have the appropriate software to do this, you are probably already familiar with the procedures. If you don't have a testing software, you can either forward test your variables or hire a testing services to do it for you. If you need a recommendation for a testing service, contact me at markdouglas.com or tradinginthe.zone.com for a referral. In any case, keep in the mind that the object of the exercise is to use trading as a vehicle to learn how to think objectively as if you were a casino operator. Right now, the bottom line performance of your system isn't very important, but it is important that you have a good idea of what you can expect in the way of a win to loss ratio, the number of winning trades related to the number of losing trades, for your sample size. Accepting the risk. A requirement of this exercise is that you know in advance exactly what your risk is on each trade in your 20 trade sample size. As you now know, knowing the risk and accepting the risk are two different things. I want you to be as comfortable as possible with the dollar value of the risk you are taking in this exercise. Because the exercise requires that you use a 20 trade sample size, the potential risk is that you will lose on all 20 trades. This is obviously the worst case scenario. It is as likely an occurrence that you will win on all 20 trades, which means it isn't very likely. Nevertheless, it is a possibility. Therefore, you should set up the exercise in such a way that you can accept the risk of losing on all 20 trades. For example, if you're trading S&P futures, your edge might require that you risk 3 full points per contract to find out if the trade is going to work. Since the exercise requires that you trade a minimum of 3 contracts per trade, the total dollar value of the risk per trade is $2,250. If you use big contracts, the accumulated dollar value of the risk if you lose on all 20 trades is $45,000. You may not be comfortable risking $45,000 on this exercise. If you're not comfortable, you can reduce the dollar value of the risk by trading S&P mini contracts. They are one-fifth the value of the big contracts, so the dollar value of the risk per trade goes down to $450 and the accumulated risk for all 20 trades is $9,000. You can do the same thing if you're trading stocks. Just keep on reducing the number of shares per trade until you get to a point where you are comfortable with the total accumulated risk for all 20 trades. What I don't want you to do is change your established risk parameters to satisfy your comfort levels. If based on your research you have determined that a 3-point risk in the S&P is the optimum distance you must let the market trade against your edge to tell you it isn't worth staying in the position, then leave at 3 points. Change this variable only if it is warranted from a technical analysis perspective. If you have done everything possible to reduce your position size and find that you still aren't comfortable with the accumulated dollar value of losing on all 20 trades, then I suggest you do the exercise with a simulated brokerage service. With a simulated brokerage service, everything about the process of putting on and taking off trades, including fills and brokerage statements, is exactly the same as with an actual brokerage firm, except that the trades are not actually entered into the market. As a result, you don't actually have any money at risk. A simulated brokerage service is an excellent tool to practice within real time under real market conditions. It is also an excellent tool for forward testing a trading system. There may be others, but the only service of this nature that I know of it is Audiotrack.com. Doing the exercise. When you have a set of variables that conforms to the specifications described, you know exactly what each trade is going to cost to find out if it's going to work. You have a plan for taking profits and you know what you can expect as a win-loss ratio for your sample size. Then you are ready to begin the exercise. The rules are simple. Trade your system exactly as you have designed it. This means you have to commit yourself to trading at least the next 20 occurrences of your edge, not just the next trade or the next couple of trades, but all 20 no matter what. You cannot deviate, use, or be influenced by any other extraneous factors or change the variables that define your edge until you have completed a full sample size. By setting up the exercise with rigid variables that define your edge, relatively fixed odds, and a commitment to take every trade in your sample size, you have created a trading regime that duplicates how a casino operates. Why do casinos make consistent money on an event that has a random outcome? Because they know that over a series of events, the odds are in their favor. They also know that to realize the benefits of the favorable odds, they have to participate in every event. They can't engage in a process of picking and choosing which hand of blackjack, spin of the roulette wheel, or roll of the dice they are going to participate in, by trying to predict in advance the outcome of each of these individual events. If you believe in the five fundamental truths and you believe that trading is just a probability game, not much different from pulling the handle of a slot machine, then you will find that this exercise will be effortless. Effortless because you desire to follow through well with your commitment to take every trade in your sample size, and your belief in the probabilistic nature of trading will be in complete harmony. As a result, there will be no fear, resistance, or distracting thoughts. What could stop you from doing exactly what you need to do, when you need to do it, without reservation or hesitation? Nothing. On the other hand, if it hasn't already occurred to you, this exercise is going to create a head-on collision between your desire to think objectively in probabilities and all the forces inside you that are in conflict with this desire. The amount of difficulty you have in doing this exercise will be in direct proportion to the degree in which these conflicts exist. To one degree or another, you will experience the exact opposite of what I described in the previous paragraph. Don't be surprised if you find your first couple of attempts at doing this exercise virtually impossible. How should you handle these conflicts? Monitor yourself and use the technique of self-discipline to refocus on your objective. Write down the five fundamental truths and the seven principles of consistency and keep them in front of you at all times when you are trading. Repeat them to yourself frequently with conviction. Every time you notice that you are thinking, saying, or doing something that is inconsistent with these truths or principles, acknowledge the conflict. Don't try to deny the existence of conflicting forces. They are simply parts of your psyche that are arguing for their versions of the truth. When this happens, refocus on exactly what you are trying to accomplish. If your purpose is to think objectively, disrupt the association process, you can stay in the now moment. Opportunity flows. Step through your fears of being wrong, losing money, missing out, and leaving money on the table. Then you will know exactly what you need to do. Follow the rules of your trading regime as best as you can. doing exactly what your rules call for while focused on the 5 fundamental truths will eventually resolve all your conflicts about the true nature of trading. Every time you actually do something that confirms one of the 5 fundamental truths, you will be drawing energy out of the conflicting beliefs and adding energy to a belief in probabilities and in your ability to produce consistent results. Eventually, your new beliefs will become so powerful that it will take no conscious effort on your part to think and act in a way that is consistent with your objectives. You will know for sure that thinking in probabilities is a functioning part of your identity when you will be able to go through one sample size of at least 20 or more traits without any difficulty, resistance, or conflicting thoughts distracting you from doing exactly what your mechanical system calls for. Then and only then will you be ready to move into more advanced subjective or intuitive stages of trading. A final note: try not to prejudge how long it will take before you can get through at least one sample size of trades. Following your plan without deviation, distracting thoughts, or a hesitation to act, it will take as long as it takes. If you wanted to be a professional golfer, it won't be unusual to dedicate yourself to hitting 10,000 or more golf balls until the precise combination of movements in your swing were so ingrained in your muscle memory that you no longer had to think about it consciously. When you're out there hitting those golf balls, you aren't playing an actual game against some or winning the big tournament. You do it because you believe that skill acquisition and practice will help you win. Learning to be a consistent winner as a trader isn't any different. I wish you great prosperity and would say good luck, but you really won't need luck if you work at the acquiring the appropriate skills. आगे इसका एटीट्यूड सर्वे है जो कि स्टार्टिंग में भी था। तो बेसिकली इसमें ये है कि आप जब सीख जाओगे, ये पूरी बुक समझ जाओगे, तो आपको ये सर्वे करना है कि क्या इसमें सही है, क्या गलत है। कि जब आप, जैसे आपको मैं कुछ एग्जांपल्स बताता हूँ। टू मेक मनी एज अ ट्रेडर यू हैव टू नो व्हाट द मार्केट इज गोइंग टू डू नेक्स्ट, अग्री और डिसअग्री। ऑफ कोर्स आफ्टर रीडिंग द बुक यू विल से डिसअग्री, बट अगर आपने बुक नहीं पढ़ी होती तो आप ये कहते कि हमें पैसा बनाने के लिए ये जानना ज़रूरी है कि मार्केट आगे क्या करने वाला है, तो आप यहाँ पे अग्री करोगे। लेकिन अगर आपने ये बुक के सारे चैप्टर्स ध्यान से पढ़े हैं तो आप यहाँ पे डिसअग्री करोगे। नेक्स्ट है समटाइम्स आई फाइंड माई सेल्फ थिंकिंग दैट देयर मस्ट बी अ वे टू ट्रेड विदाउट हैविंग टू टेक अ लॉस। पहले इसमें सब लोग यही करते हैं कि अग्री करते हैं इस चीज़ से कि कैसे भी करके लॉस ना हो, बट बेसिकली ऐसा नहीं है। आपको लॉस आज नहीं तो कल होगा। ये एक प्रोबेबिलिटी गेम है, किसी में आपको लॉस होगा, किसी में आपको प्रॉफिट होगा, तो यहाँ भी आप डिसएग्री करोगे। मेकिंग मनी एज ए ट्रेडर इज़ प्राइमरली अ फंक्शन ऑफ एनालिसिस। देखो इसमें क्या है ना कि ये एटीट्यूड सर्वे इस तरीके से बनाया गया कि आपको ये पूरी बुक को एक बार नहीं, दो बार नहीं, 4 बार अगर आप पढ़ोगे तब जाके आप ये सारे जो क्वेश्चंस हैं इनका रियल आंसर्स दे पाओगे। तो ये मैं आगे आपको चला देता हूँ, इसका मैं आंसर आपको दूंगा नहीं, नहीं तो फिर आपको कोई फ़ायदा नहीं होगा। Number 4, losses are an unavoidable component of trading. Of course losses are unavoidable component of trading, पर पहले लोग कहते थे कि losses को आप avoid कर सकते हो। My risk is always defined before I enter a trade. अभी क्या होता है कि जब आप, मैं चाहता नहीं कि आप लोगों को ये आंसर बताऊं, तो आप इसलिए प्लीज़, मैं सिर्फ पढ़ रहा हूँ, आप इसको आंसर खुद करिएगा। Number 6, in my mind there is always a cost associated with finding out what the market may do next. Number 7, I wouldn't even bother putting on the next trade if I wasn't sure that it was going to be a winner. Number 8, the more a trader learns about the market and how they behave, the easier it will be for him to execute his trades. My methodology tells me exactly under what market condition to either enter or exit a trade. Even when I have a clear signal to reverse my position, I find it extremely difficult to do. I have sustained periods of consistent success, usually followed by some fairly drastic drawdowns in my equity. When I first started trading, I would describe my trading methodology as haphazard, meaning some success in between a lot of pain. I often find myself feeling that markets are against me personally. Number 14. As much as I try to let go, I find it very difficult to put past emotional wounds behind me. I have a money management philosophy that is founded in the principle of always taking some money out of the market when the market makes it available. Number 16. A trader's job is to identify patterns in the market's behavior that represent an opportunity and then to determine the risk of finding out if these patterns will play themselves out as they have in the past. Sometimes I just can't help feeling that I am a victim of the market. When I trade, usually try to stay focused in one time frame. Trading successfully requires a degree of mental flexibility far beyond the scope of most people. There are times when I can definitely feel the flow of the market, however, I often have difficulty action on the feelings. There are many times when I am in profitable trade and I know the move is basically over, but I still won't take many profits. No matter how much money I make in a trade, I am rarely ever satisfied and feel that I could have made more. When I put on a trade, I feel I have a positive attitude. I anticipate all of the money I could make from the trade in a positive way. The most important component in a trader's ability to accumulate money over time is having a belief in his own consistency. If you were granted a wish to be able to instantaneously acquire one trading skill, what skill would you choose? I often spend sleepless nights worrying about the market. Do you ever feel compelled to make a trade because you are afraid that you might miss out? Although it doesn't happen very often, I really like my trades to be perfect. When I make a perfect call, it feels so good that it makes up for all the times I don't. Do you ever find yourself planning trades you never execute and executing your trades you never planned? In a few sentences, explain why most traders either don't make money or aren't able to keep what they make. So that's the end of the book and इसी के साथ ट्रेडिंग इन द जोन बुक ख़त्म करते हैं हम यहाँ पर और ये चैप्टर 11 एंड करते हैं जो कि फाइनल चैप्टर था। अब मैं एक पूरा इस सबको एक जोड़ के पूरा एक चैप्टर बना दूंगा, पूरी एक बुक का एक साथ डाल दूंगा ताकि जो पूरा एक साथ पढ़ना चाहता है वो पढ़ सके। तो मिलते हैं आपसे अगली वीडियो में अगली बुक के साथ। मोस्ट प्रॉब्ली द डिसिप्लिन ट्रेडर को हम करेंगे जो कि अगेन ट्रेडिंग पे ही है। ट्रेडिंग पे ही मैं कवर करता हूँ क्योंकि मेरा प्रोफेशन भी ट्रेडिंग है। तो मिलते हैं आपसे अगली वीडियो में, तब तक के लिए टेक केयर, सी यू, बाय।